Hello everyone, you're welcome to my channel Promotion for Sure. In this video, we are going to talk about the ratio analysis, Module D of Bank Financial Management, CAIIB. Now, this is going to be a summary video which will be very quick. If you want to get a copy of this PPT in PDF format for quick revision, you can download from the link mentioned in the description box below. So ratio analysis is a concept or a technique which is as old as accounting concept. Financial analysis is a scientific tool. It has assumed important role as tool for appraising the real worth of an enterprise, its performance during the period of time and its pitfalls. Financial analysis is a vital apparatus for the interpretation of financial statements. It also helps to find out any cross-sectional and time series linkages between various ratios. Now, unlike in the past when the security was considered to be sufficient consideration for the banks and financial institutions to grant loans and advances, nowadays the entire lending is need based, and on the emphasis is on the financial viability of the proposal and not only on the security alone. Further, all business decisions contain an element of risk. The risk is more in the case of decisions relating to credits. Ratio analysis and other quantitative techniques facilitate assessment of this risk. Now, what is ratio analysis? Ratio analysis means the process of computing, determining, and presenting the relationship of related items and groups of items of the financial statements. They provide in summarized and concise form a fairly good idea about the financial position of a unit. They are important tools for financial analysis. Now, why is financial analysis required? Lenders need it for carrying out the following activities: technical appraisal, commercial appraisal, financial appraisal, economic appraisal, and management appraisal. Now, ratio analysis is a tool for which it enables the bankers to lender or the lender to arrive at the following factors: liquidity position, profitability, solvency, financial stability, quality of the management, safety and security of the loans and advances to be or already been provided. Now, before looking at the ratios, there are a number of cautionary points concerning the use that need to be identified. Now, the dates and the duration of the financial statements being compared should be same. If not, the effect of seasonality may cause erroneous conclusion to be drawn. The accounts to be compared should have been prepared on the same basis. Different treatment of stock or depreciation or asset valuation will distort the results. In order to judge the overall performance of the firm, a group of ratios as opposed to just one or two should be used. In order to identify trends, at least 3 years of ratios are normally required. The utility of ratio analysis will get further enhanced if the following comparison is possible: between the borrower and the competitor, between the borrower and the best enterprise in the industry, between the borrower and the average performance in the industry, between the borrower and the global average. Now, these are certain parameters which can be considered. Now, how a ratio is expressed as percentage, such as 25% or 50%. For example, if net profit is 25,000 and the sales is 1 lakh, then the net profit can be said to be 25% of the sales. As proportion, the above figures may be expressed in terms of relationship between net profit to sales as 1:4. As pure numbers or by times, the same can be also expressed alternatively, such as sale is 4 times of the net profit or the profit is 1/4 of the sales. Now, classification of ratios is into three parts: balance sheet ratio, profit and loss ratio or income revenue statement ratio, balance sheet and profit and loss ratio. Now, financial ratios are current ratio, quick asset ratio, propriety ratio, and debt equity ratio. Operating ratios are gross profit ratio, operating ratio, expense ratio, net profit ratio, stock turnover ratio. Now, composite ratios are fixed asset turnover ratio, return on total resource ratio, Return on own funds ratio, earning per share ratio, and debtors turnover ratio. Now, format of the balance sheet for the ratio analysis, basically it's divided into two parts: liabilities and assets. Liabilities are certain things which you owe. An asset is something which you own. It is your money. The asset is something which belongs to you. And liabilities is something which you have to give to the people. So if you have to calculate net worth, equity, own funds, you will be using liability. If you have to use debt equity ratios, you will be using long term liabilities and borrowed funds. Current liabilities. For assets, fixed assets, non current assets, and intangible assets. Now, this one slide is a very important slide which gives you a brief description of all what comes in assets and liabilities. Now, some important notes: liabilities have credit balance and assets have debit balance. Current liabilities are those which have either become due for payment or shall fall due for payment within 12 months from the date of balance sheet. Current assets are those which undergo change in their shape form within 12 months. These are also called working capital or gross working capital. Net worth and long term liabilities are also called long term sources of funds. Current liabilities are also known as short term sources of funds. Long term liabilities and short term liabilities are also called outside liabilities. Current assets are short term use of funds. Now, assets other than current assets are long term use of funds. Installment of term loan payable in 12 months are to be taken as current liability only for the calculation of current ratio and quick ratio. If there is profit, it shall become a part of the net worth under the head reserve, and if there is loss, it will become a part of intangible assets. Investments in government security to be treated current only if these are marketable and due. Investment in other securities are to be treated current if they are quoted. Investment in allied or associate sister units of firms to be treated as non-current. Bonus shares as issued by capitalization of general reserves and as such do not affect the net worth with regards issue. Change takes place in the net worth and current ratio. Now, current ratio, it is the relationship between the current assets and current liabilities. Current ratio is current assets upon current liabilities. This is an example which you can see. The ideal current ratio preferred by bank is 1 is to 1.33 is to 1. Net working capital, this is worked out as surplus of long-term sources over long-term uses. Alternatively, it is difference of current assets and current liabilities. So net working capital is current assets minus current liabilities. Now, current assets: raw materials, stores, spares, work in progress, finished goods, debtors, bill receivables, cash. Current liabilities: sundry creditors, installment of term loan, deferred payment guarantee, etc., payable with 1 year, and other liabilities payable within 1 year. This ratio must be at least 1.33 is to 1 to ensure minimum margin of 25% of current assets as margin from long-term sources. Now, current ratio measures short-term liquidity of the concern and its ability to meet its short-term obligations within a time span of a year. It shows the liquidity position of enterprise and its ability to meet current obligations in time. Higher ratio may be good for the point of view of the creditors. In long run, very high current ratio may affect profitability. It shows the liquidity at a particular point of time. The position can change immediately after that date. So trend of the current ratio over the years is to be analyzed. Current ratio is to be studied with the changes of net working capital. It is also necessary to look at this ratio along with debt equity ratio. Now, asset test or quick ratio, it is the ratio between quick current assets and current liabilities. Now, this should be equal to 1. So, quick current assets are cash bank balances plus receivables up to 6 months. Quick realizable securities such as government securities or quick marketable quote shared in bank fixed deposits. So, asset test or quick ratio is quick current assets minus amount current liabilities. So this is an example which you can take. Now, debt equity ratio, it is the relationship between the borrower's fund, which is debt, and owner's capital, which is equity. Long-term outside liability divided by tangible net worth. So owner capital is net worth and the debt is long-term liabilities. Liabilities is something which you have to pay. Now liabilities of long-term nature, total of capital in reserve and surplus less intangible assets. So this is an example which you can see. Propriety ratio, this ratio indicates the extent to which tangible assets are financed by owner's fund. So propriety ratio is equal to tangible net worth divided by total tangible assets into 100. So the ratio will be 100% when there is no borrowing for purchasing of assets. Gross profit ratio, by comparing gross profit percentage to net sales, we can arrive at the gross profit ratio, which indicates the manufacturing efficiency as well as pricing policy of the concern. So gross profit ratio is gross profit divided by net sales into 100. Alternatively, since gross profit is equal to sales minus cost of goods sold, it can also be interpreted as below. So gross profit ratio is sales minus cost of goods sold divided by net sales into 100. A higher gross profit ratio indicates efficiency in production of the unit. Operating profit ratio, it is expressed as operating ratio divided by net sales into 100. Higher ratio indicates higher operational efficiency. So net profit ratio is net profit divided by net sales into 100. It measures overall profitability of the organization. So stock inventory turnover ratio, you can go through it. So average inventory of stock is opening stock plus closing stock divided by 2. This ratio indicates the number of times the inventory is rotated during the relevant accounting period. Debtors turnover ratio, this is also called debtors velocity or average collection period or period of credit given. You can go through the formula. Asset turnover ratio is net sales divided by tangible assets, and fixed asset turnover ratio is net sales divided by fixed assets. Current asset turnover ratio is net sales divided by current assets. Creditors turnover ratio, this is also called creditors velocity ratio, which determines the creditor payment period. So return on asset, net profit after tax divided by total asset. Return on capital employed, net profit before interest and tax divided by average capital employed into 100. So average capital employed is the average of the equity share capital and long-term funds provided by the owners and the creditors of the firm at the beginning and at the end of the accounting period. So composite ratio, return on equity capital, net profit after taxes, and tangible net worth. You have to divide both of them. Earning per share indicates the quantum of net profit of the year that would be ranking for dividend for each share of the company being held by the equity shareholders. So net profit after tax and preference dividend divided by number of equity shares. Price earning ratio indicates the number of times the earning per share is covered by its market price. So market price per equity share divided by earning per share. Debt service coverage ratio. This ratio is one of the most important one, which indicates the ability of an enterprise to meet its liabilities by way of payment of installment of term loans and interest thereon from out of the cash accruals, and forms the basis of fixation of repayment schedule in respect of term loans raised for a project. So the ideal DSCR ratio is to be 2. So profit after tax plus depreciation plus annual interest on long-term loan and liabilities divided by annual interest on long-term loans and liabilities plus annual installments payable on long-term loans and liabilities. Okay, so this is an exercise which you can pause and go through. What is the net worth? Capital plus reserve, tangible net worth minus goodwill. Outside liabilities, term loan plus cash credit plus creditors plus provision. Net working capital, current assets minus current liabilities. Current ratio, current assets upon current liabilities. Quick ratio, quick assets divided by current liabilities. So this one exercise will give you the exercise for entire uh, questions which we have learned: debt equity ratio, tangible net worth, total outside liability divided by total tangible net worth. These are the things which you can calculate. Current ratio. Okay, you can quickly go through it. You can pause the video, you can do the exercise, and you can get the results as well. You can pause the video, you can see how you can do these questions. These MCQs will be very useful for you to clear the exam, because this is how the questions are normally asked. And if you're able to do all these questions, you will surely score better marks. So I hope this video would have certainly given you a lot of valuable knowledge and insight, and would have given you a valuable information too also. So this is something which you have to do, and I'm sure you'll be able to get good results as well. And you can go through these questions, and these questions will surely help you to clear the exam. You can also download the copy of the PDF from the link which I've put there in the description. So if you like this video, you can press the like button, subscribe to our channel, and share this video on social media. Help us to spread education in this beautiful world. Thank you. Have a great day.